I think the positive surprise is this time is a whole package of coordinated policies, right? I mean, in the past, we had these piecemeals here and there, triple R cuts, LPR cuts, even mortgage-backed book repricing happened September last year. But this time it comes as a whole package, right? And it addressed the lending rate, talk about deposit rate, and it even talked about stock market, right? Potentially granting relending for the stock market buyback. So I think, this time it certainly shows that the financial regulators on the monetary policy side, at least, has become much more coordinated, and they're willing to do somewhat a big bang to sort of boost the investor confidence, to, inject more energy, inject more confidence in the market.
Yep. Confidence is what the market needed. I was reading about money coming out of the Chinese markets, flowing offshore. But in terms of beneficiaries, the sectors, what asset classes will be moving in reaction to all of this?
I would say for the short term, we'll play the large cap high beta names, right? Large liquid high beta names. So the banks, insurance, tech names, internet names, those are probably the easy beneficiary in the risk on rally. But in terms of the real benefit to the economy, it really takes time to see, right? Especially on the property sector. Now, lowering down payment, lowering rate helps. But at the end of the day, household will not buy depreciating asset, right? So for property market to really turn around, we really need to see property price to stabilize. We need to see people's confidence on jobs and income to recover, which are still somewhat missing pie in this environment. So, we remain relatively cautious on the property market. They might have a very quick bounce, but we don't think it's the best way to invest, but instead maybe buy the property derivatives, which are financials, banks and insurance companies with higher property exposure, and potentially some of the consumer names like home appliances, which could potentially benefit from better home sales. On the other side, I think the consumption recovery still takes longer term to happen. We're still seeing the loss of income, loss of jobs. We are not seeing many new high-paying jobs created in the market. So, on consumer sector, we remain relatively cautious.
Winnie, Sam here out in Singapore. Is this the big bazooka?
I think it certainly helps, but not enough. I would say that, for bazooka, we probably need more physical side, more expansionary policy on the physical side to, for example, if we have 20 trillion of local government debt swap over the next 3 years, it will be a policy bazooka. And on top of that, I think there are structural issues to be addressed. So, for example, concerns about overcapacity and deflationary pressure. So supply-side reform is the structural reform that's needed. So, this policy package certainly helps, right? Valuations low, positions low, markets being beaten down. So this should drive a rebound, a recovery. But for the rally to sustain, we probably need more from physical side, from structural reforms.
Okay, and what about the securities watchdog commentary this morning? We were just talking to Jack Dwyer, and he was saying that we should be taking the CSRC's comments with a grain of salt.
Stock market is only a reflection of the underlying economy. All right, so injecting liquidity, doing buyback, increasing payout, those are all helpful. But at the end of the day, we need corporate earnings to turn around. We need the real fundamental economy to improve. We need household income, job outlook to improve. So, I appreciate that the financial regulators are trying to do more to support market confidence, which are all helpful. But as I said, at the end of the day, stock market is only a reflection of the underlying economy. And for the underlying economy to really bottom and turn around, we need more policies to address the structural reforms, to address the local government debt problem, the property market downturn.